Air Canada on Tuesday held its Investor Day, where the company said it is targeting a 36% jump in its 2028 operating revenue from the current year, riding a wave of strong demand for leisure travel. Air Canada is among the airline stocks with a buy rating. From our next guest, joining me is Stephen Trent, Managing Director of America's Airlines and Latin Transport at Citi. How are you, sir? Thanks for joining us, Stephen.
No, thank you for having me this morning.
All right, so let's start with Air Canada for obvious reasons. We're a Canadian network, but we're global as well. But you're looking at margin expansion, cash generation, and a strong balance sheet. You like what you're seeing here?
I sure do. So certainly the street, at least over the short term, took a less sanguine view with some elements of the guide. They are going to have some seat mile cost pressure as we look into next year. And you look at non-U.S. airlines, we also have to think about the potential currency impact. But overall, big picture looks very good. We thought the long-term guide looks great. They have the components they need to generate more revenue and more free cash flow, similar to what you're seeing with the U.S. network majors.
So, Stephen, your top choice here is Copa, which has a long history, but it's not an airline that people have top of mind necessarily. So what is it about Copa? Why is it a buy, and why do you think it's mispriced?
Yeah, absolutely. So if you look at the airlines in the Americas from Canada down to Chile, you know, the strongest performers got an EBIT margin of 12-13%. Copa's got closer to 22%. It serves, it has a preponderance of low-density routes within its network, where on those routes it practically has monopoly power. So you're talking about a carrier that also has 7% cash dividend yield, and in a bad year will generate $100 million of free cash flow. So it's on a long-term basis our favorite. Short-term, it does have some issues against its back. And certainly on Citi's focus list, American Airlines is one that comes more to mind short-term, but long-term, Copa is hard to beat.
All right, Stephen, in terms of the larger airlines, Delta, United, American, Alaska Air are your favorites. And you like, in part, their offerings, their long-haul connectivity, and their loyalty programs as well. So can you expand on those three things?
Sure, absolutely. So we're still in an environment where premium is preferred. There's very good demand for premium. If I understand correctly, 40-some-odd% of the U.S. population has annual income of $100,000 or more, but that segment is 70% of U.S. employments per capita. And when you look at the network airlines, probably that percentage is higher. So relatively wealthy people still want to travel. And if you look at the segmentation of the cabin today versus 20 years ago, Delta, United, American Airlines really have a good opportunity to optimize revenue in the cabin based on segmentation, whether it's economy plus or business class, or some people still wanting to fly main cabin. And then beyond that, the loyalty programs. You know, these businesses are generating a lot more cash flow than they used to from people simply using their credit cards for day-to-day reasons, not just buying airline tickets. So those factors also, I think, play a big role in de-risking these earnings streams more than the street is currently giving them credit for today.
Stephen, you also point to the airlines, most of them anyway, having co-branding arrangements with financial institutes for credit cards. So what are the advantages for the airlines having these co-branding arrangements and for the banks as well?
Yeah, absolutely. So for the airline side, the cash flow stream is potentially enormous. So you have working capital tailwind, and high margin revenue coming from cards. So people that go out and use their co-branded card to buy gasoline or groceries, not just people buying airline tickets. So you have more of a broad consumer-related cash inflow coming from these verticals that is helping the airlines to de-risk their earnings stream. So that's very, very important. And that's, I think, a big source of higher earnings quality as we go forward. You know, from the bank side, that's a touch outside my wheelhouse, but I will say the largest programs probably recognize a much greater opportunity for fee revenue from large loyalty programs and from wealthier frequent flyer pools, a greater opportunity for cross-selling. Maybe some customers want auto loans. Maybe some of them want to refi their mortgage.
Right.
So I think the opportunity from one of the big three is significant versus a regional airline or a low-cost carrier that doesn't have the same punch in terms of the profile of their passenger flow.
And just lastly here, Stephen, if we could get 15 seconds out of you on Bombardier. You say it's a much stronger, more stable company than it used to be.
Yes, significantly more. So no more rolling stock business, no more commercial jet, just business jet now, where for all intents and purposes, the ultra long range segment is a duopoly. I think the market is potentially going to be surprised with the extent to which you see that company using its equipment for defense, surveillance, and military purposes. They just delivered their first plane to the U.S. military's Hades program. And you look at an aircraft like that with high service ceiling, very long range. You have, I think, very important surveillance capability, electronic warfare capability, which the street does not fully recognize in terms of the potential delivery stream and from the margins they could get off that business. So,
right.
You know, we continue to be fans of Bomber as well.
All right, and quite a run for that stock, as you know, the last 4 or 5 years or since the pandemic. Thanks so much, Stephen. We appreciate your time today.
Thank you and happy holidays.